Hey there, thank you for joining us today. My name is Carrie Sobel. I am the Chief Marketing Officer at the Coastal Investment Company, and I am joined today by three spectacular professionals. Counterclockwise, we have Richard Hayes. Richard Hayes is an advisor with Coastal, and he is also our in-house CPA and tax strategist. And we are joined today by Jason DeBono, who is the president of NuView. And we are also joined by Matt Chansey, who is also on the Coastal team. Matt is one of our advisors and helps out with our due diligence and some of our deal sourcing. I think you're going to enjoy today's conversation. But again, our guest today is Jason DeBono from NuView. And NuView is a strategic partner of Coastal's. And Jason, if you wouldn't mind, can you tell us a little bit about what NuView does? And prior to that, I had a little thing I wanted to say, a little tidbit, is that the alternative asset market is going to grow from 13.9 million to trillion with a T to 17.3 trillion by 2025. And NuView is a custodian of alternative assets. So could you tell us a little bit about what that means and what that is?
Yeah, happy to. So NuView Trust Company is a third-party custodian. We serve a very similar role to a Schwab or a Fidelity, but the type of assets that we custody is outside the public market. So, we tend to kind of think of alternatives as being something so different and so unique. And really, alternatives for the most part are just private. They're not publicly available. And so as a result, many custodians like Schwab and Fidelity simply choose not to hold those types of assets, no different than Subway chooses not to sell cheeseburgers, right? So our role is, we're a regulated entity. We hold and custody assets. We do all the same reporting to the IRS that Schwab and Fidelity and any other custodian does. So you're not really changing your IRA. You're just simply choosing to hold it at a custodian that'll let you park the investments into alternative assets.
Excellent. And you guys have grown significantly over the years. I think you were founded in 2003. And the stats that I saw was as recently as 2021, you had $2 billion in assets under custody. Yep. I'm sure that's even continued to grow a little bit more.
It has. We're almost $2.5 billion of assets, continuing to grow fast. I think going back to your stat on the alternative markets, most investors are realizing that alternative assets are not this scary, different asset class. In fact, if you look at alternative assets, the Harvard endowment model, which is really the pinnacle of investing money, has always been 40 to 50% alternatives. And so the advisory markets, the individual investors are starting to realize that alternative assets produce typically more consistent results, above average results with a lot less volatility than the public markets. I mean, heck, look at being a stock market investor over the last 3 years. It's gone up and gone down, and depending on what you buy, and the emotional roller coaster that you're on, that's tough to navigate. Whereas if you invested money into a private real estate equity deal, it's set it and forget it, right? And you're kind of sitting back and riding that hopefully into good success.
Yeah. And, we talk about alternative assets because that's what we do at Coastal. In all of the topics that we cover, alts is tippy top. And they're typically structured to outperform the markets, to your point. But I think a lot of people don't understand what alternative assets even are. So maybe we kick off with that. And what role does NuView play in being a custodian of? Like, how does it work with Coastal is something I definitely want to cover. So what are alts? What are alternative assets for people that are?
I'll jump in. I think he's getting tired of talking. So for a minute, take a break. Alternative assets, I think the definition has changed a lot over the past couple of decades. Originally, it started off with things that you would buy in like an ETF or a mutual fund wrapper, managed futures, master limited partnerships, just because they weren't traditional stocks and or bonds. I think those were some of the first iterations as I remember them over the past 20 years. But I think really more what we're talking about for the context of this conversation, it's applicable to hard assets. And hard assets should be real estate in the way that I think about it in the context of the way Coastal functions, right? And for the sake of this conversation, hard assets, real estate, right? And so real estate is anything from potentially buying a house that you want to rent out as a maybe your own beach Airbnb type property if you were into that kind of thing, or a house in your neighborhood that you were going to rent. If you wanted to do it yourself, some people don't know you could use your self-directed IRA for that. I think the way we play the game is we're using institutional assets. So we're building self-storage, building multifamily, investing in private credit and private notes. So I think there's a lot of other strategies in the private markets today. That's not where it started, or that's not what an alternative investment was, but that's what the alternative investment landscape has expanded to. So I think that 17 trillion number is also an expansion of what's considered an alternative as well.
Yeah, and I think alternatives today, I mean, if you think about the evolution, I think you kind of highlighted it, they're really things we see every day. I mean, for simplicity purposes, crypto is an alternative, right? Mm-hmm. Yet most people would kind of view crypto as if you want to buy it, you just go buy it. And I think you're seeing that same thing come into the real estate market. I think what a lot of people don't see in the real estate market is the ability to get into institutional real estate. Mm-hmm. So there's a lot of value in buying that Airbnb, and there's a lot of value in buying real estate and renting it out. And that's a very good entry point. And if you watch TikTok videos or any of these, they're really pushing that hard. And so I think if you look at real estate prices, what's driven them up is not just the average person buying a home so they can live in it. It's all these investors. And we kind of look at these big corporate, conglomerates, and we kind of say, oh, they're ruining the real estate market. There's just so many individual investors buying real estate today, unlike 5 years ago, 10 years ago. But it's that institutional real estate. If you drive down the road and you look at every piece of real estate that's not a house, that's almost all considered to be institutional real estate, right. Whether it be storage, multifamily, industrial, flex properties. I mean, you could go on and on. And so those deals, because they're so much bigger in size, are packaged up and sold out to the marketplace. And they're sold to hedge funds, and they're sold to life insurance companies that can write multi-million-dollar checks. But what most people don't know is they're actually packaged up and sold to individuals. Mm-hmm. And I think that's where, a self-directed IRA and an alt custodian like NuView come in, is that, we are not the place where you come to pick out your assets, right? You go to Schwab to pick out your stocks. For us, we don't have a menu of investments. The world is your oyster. So when you find these types of investments like a Coastal, and you've done your due diligence and you realize, hey, I can invest into these institutional grade assets, right? As an individual investor, that's where NuView comes in to provide that custody needed for you to have access to those assets through your retirement funds.
Let me piggyback on that for a minute. I think you brought up a really interesting point. I don't think everybody realizes that Schwab has multiple business lines. One is to get you to park your money there and hold it at Schwab, because Schwab's a trusted company and they're not going to steal your money. So park it at Schwab. And once it's parked there, it's convenient that somebody from Schwab will reach out and go, hey, would you like to buy something from Schwab Investment Services, since we know you have money to buy stuff? And that's not something that their company does. You park it there and they're going to protect it while it's parked there and make sure that it's parked there and accounted for the right way. But they're not, once the money's parked, they're going to turn around and try to start selling you investments from their investment side of their business. They don't have an investment side of the business. Right.
So just dipping our toe in the tax waters for a minute, right? Why might a well-informed CPA like an alt for their clients? So just very high level, for starters, alts will create a cash flow frequently to their investors. And that cash flow can be structured such that the investor feels like they're getting an interest or dividend payment, but in fact, it's a return of capital. So there's no tax triggered. And another element of these alt investments that's beneficial from a tax perspective is there's usually no tax liability till the end of the project. The project is liquidated and sold. And that gain is long-term capital versus ordinary income. So we're talking about 20% versus 37%. And frequently a full deferral from the beginning of the project all the way to the liquidation. So I think a well-informed CPA likes that for their clients versus a retail investment that's going to trigger taxable income year in and year out.
Yeah, the tax bit of real estate, I think, is probably the world's greatest secret that's still hidden. And if you look at it, just pull up the Forbes top 100 wealthiest people, and 85% or more have the majority of their wealth in real estate. And it's not just the returns that they're after. That's a great piece. It's the returns coupled with the tax benefits. Mm-hmm. And that's when you start to really, really see results.
And everything we say that we do and work on here at Coastal is either tax efficient or tax deferred. And, a lot of the people that come to us to invest, they either don't know about alternative assets, They don't understand how to do the thing. Maybe they own a piece or two of real estate themselves. But if you really are not a full-time flipper or a full-time property manager, we offer a lot of value to our customers and our clients to come here, get the education on what alternatives are, and find different ways to deploy the funds that you have into investments. One of the ways, the simplest ways, is when they write a check to Coastal in cash. Another way that they can do it, one of the things I really wanted to drive home today was you can utilize a self-directed IRA to make your investments. You can take your 401k from a qualified plan. You can roll that over into a self-directed IRA. Maybe you have a ton of market exposure and you want to diversify a little bit more. That's a great opportunity to engage with NuView.
Yeah, and if I can, I'll give you a quick kind of parallel in story form on how that works and how taxes work. So we'll just start with Matt, right? Matt, let's just say, takes $1 and he doubles it every year for the next 20 years, right? Now, Matt's in a 25% tax bracket.
That's because I'm a great investor, by the way.
Correct.
I just wanted to let you know.
Correct. And he does it with a 25% tax bracket, right? And he just buys an investment that may not be terribly tax efficient, but he takes that buck and he doubles it every year. So it turns into $2 and then he pays a quarter of tax off his dollar of earnings, and you get the idea. At the end of 20 years, you're going to have about 60 grand. Now, 20 years
started
from
with
now,
$1. That's pretty awesome.
You're going to be sitting around with your buddies. You're going to be high-fiving. You're going to be telling them, hey, guys, 20 years ago, I turned $1 into 60 grand, like drinks are on me. Now let's move to Rich, right? He takes the same dollar, puts it into the same investment, but he doesn't put it through his personal money, which has that 25% clip. He puts it in his traditional IRA, which means it's tax deferred. Now, 20 years from now, he's sitting around with his buddies and he's talking about how he turned his dollar into $1,050,000.
Wait a minute. That makes me sound not so good.
Just wait.
Story.
Yeah, and it gets better. There's more, right? So just think about that contextually, right? Same dollar, so there's not a better saver in the group. Same investment, so there's not a better investor. But Rich used the tax benefits of a traditional IRA to defer the taxes to the very end. Now, the great news is he's got $1 million and change, right? The drawback is he's got to pay tax as he withdraws it. But even if he's paying 40% tax, right? He's got 600 grand. He's 10x'd the same exact deal. Now let's go to Carrie. Same dollar, same investment, same 20-year time horizon, but he decided to put his into a Roth IRA. So he paid Uncle Sam on his dollar. And let's assume he's in the 37% tax bracket, so it costs him 37 cents, which is a painful bit to give away off his buck, right? That dollar grows to the exact same $1,050,000, right? But it's now 100% tax-free. So think about how taxes, right, impact your investments. And so I think what we don't do as investors is we don't think about the whole picture, right? Oh man, this deal makes me 15%. Well, 15% in a short-term capital gain is probably not as good as 10% in a long-term capital gain, which is probably not as good as 8% tax-free, right? So you have to kind of add all these up. So what I love about this story is if you think about it, every one of you thinks you're brilliant. And you're going to tell all your buddies that you're brilliant. But the reality of where you are is that the only brilliant one at the group is Carrie, because he realized that he made the same investment, the same saver. And I could carry this story on in a lot of different scenarios. What if you just saved a few extra bucks? You cut out Starbucks and you cut out that expensive dinner and you started with $2, right? So if you're thinking about what this looks like, investing is a journey, and that journey does require you to think about how do you save, right? Because you got to have capital to invest. How do you pick the right investments? But the right investment is not some sexy, shiny, glossy investment that someone says it's going to yield you return, right? It's why crypto has so much popularity. But at the end of the day, people have made money on it and people have lost a lot. Mm-hmm. But again, go back to the Forbes wealthiest list. Over 85% is in real estate. And I guarantee you they're not doing it in their taxable accounts unless it makes sense. And when the tax benefits aren't there, they're still buying real estate with tax deferred money like pension money, especially tax-free money like a Roth.
You know, that is such a powerful story, and you're a better storyteller than any CPA I've ever met, because we're constantly trying to get that point across to clients. And, you know, my mission with Coastal, and Matt, you had a lot to do with my philosophy in public accounting, growing and changing, is to get people to understand how different their balance sheet can be by deploying that strategy. And what's a self-directed IRA? It's really that there's no difference in an IRA and a self-directed IRA, except the underlying assets that you put in it. But the power of taking money off of Uncle Sam's balance sheet and keeping it on yours, and then, as you said, you're not any better of an investor. You're just performing so much better. It's something that we're constantly trying to educate our clients on.
Some people might call that tax alpha, but I don't know. Call me crazy.
Well, to defend CPAs, I think if you think about it, and I'm sure everybody listening to this is guilty of it at one point, right? How do we approach our CPAs, right? We hand you our tax docs, right? Usually April 14th, right? And we look you really hard in the eyes. We won't let go of the paper, and we tell you, save me as much money as you can. And what we're really saying to our CPA is, do what makes sense today. Because I don't want to hear how you're going to save me money in 8 years. I want to know, I want my taxable to be as low as possible this year. And that, unfortunately, is not how wealth is built, right? I should look at you and say, hey, you are way smarter at this than I am. I want to be wealthy over time, not just have an extra 5, 10, 20 grand this year. What's the best strategy to get there? And I think most CPAs will say, gosh, like you just licensed me to actually think a little differently. Yeah. But most CPAs, they put their head down. They've got 500 clients. They're trying to get tax returns done. And they just don't want to make that painful call to the client and say, hey, you got to write Uncle Sam an $80,000 check. They want it to be 78, right? They want it to be 74. And that's what they want to know. Instead, they said, hey, you got to write this $80,000 check. It's going to hurt. Don't blame me. You made money. First class problem, right? Go complain to someone else that cares. But guess what I did? I ensured that the $80,000 that check you wrote today is going to be significantly lower in 20 years when it really matters, when you really need the money, when maybe you're not working anymore. Like, get the tax bill paid today during your working years. That's why I love Roths, right? Pay it today. I don't need an extra 5 grand in my pocketbook today. I'll probably spend it on something stupid, but compound that over the next 20 years when I'm retired, and that's probably 500 grand. And I surely could use that money in 20 years when I'm not working, right? And so it's just, we got to change the way that we think about building wealth. And it's not just to put it in the market and set it and forget it, and eventually the S&P will perform. That's not a terrible strategy, but it's not a strategy, right? That's the path of least resistance.
Well, it should be maybe one bucket of your investment portfolio is having some market exposure. And then people aren't exposed to some of these alternative options that they have. And I think something we always talk about from a tax perspective is, there's nothing against the conveyor belt CPA that is doing your taxes for you and does save you that $2,000 and everybody's happy, check the box, right? A lot of our clients have outgrown their CPAs. And not in the form of putting down their current CPA, but there are tax strategists out there that are CPAs that think about these things for the long-term perspective. And that's something that we always tell our clients. If you can save some money in tax by planning for the future, you're letting your investments really start to get some traction. And it's a simple concept that look at who is advising you from a tax standpoint on an annual basis and think in the long term instead of the short term.
I think it's obvious that investing is a long-term, it's a long-term project, right? But I think people think of taxes sometimes as binary, on or off, and annual. And in reality, it's very much a long-term strategy. So when I talk to young guys like Carrie, and they're not always real excited about deferred comp and retirement plans, but building up assets in a deferred comp plan and then deploying a self-directed IRA or converting to a Roth and using strategies to convert. These are long-term strategies that are explosively powerful, going back to your example of that buck. So we do a lot of work on this strategy is not going to create a huge savings this year, but 5 years from now, you're going to wrap your arms around me and you're never going to forget what you did 5 years before that creates all these new opportunities.
Sure. Absolutely. Let me piggyback on some of these ideas. So a lot of people are familiar with the concept of asset allocation, right? How do I diversify and put, how do I own a little bit of bonds and stocks and private real estate and private credit and venture capital? How do I diversify across asset types? What's less commonly spoken about is asset location, right? And so asset location is a concept of how do I put the most tax efficient asset in the most tax efficient place? So I'll give you an example. A way in public markets that's commonly misused is if you ask a high net worth client, which all are potentially sold on the concept of municipal bonds at some point in time or another. And like, you should buy municipal bonds. Rich people buy municipal bonds. Well, why would I do that? Well, they generate income and it's tax efficient income. Well, the problem is if you buy municipal bonds in an IRA account at Charles Schwab or anywhere else, you get absolutely none of the tax benefits associated with municipal bonds. So you should never buy municipal bonds in a qualified retirement account with anyone. That is a bad asset location decision. Now, everybody can't make an asset location decision because if all of your savings that you would put into an investment are inside of a qualified plan, you can only use qualified plan dollars to invest. You can't make a smart asset location decision based on that. You can make the decision of, should I convert some of my qualified money from an IRA to a Roth IRA? Then that gives you location diversification from that perspective. But let's assume that you're in a different boat. Let's assume that you were going to invest with Coastal, right? And you had two buckets of money. You had some money in an IRA account and you had some money that was cash and you could invest either way. At that particular point, you need to be extremely mindful of which check you write to which investment because all these investments have attributes. Credit type programs that pay current income, dividends, or distributions usually should be in an IRA type of account. Things that have growth, capital appreciation, and tax benefits that flow through, and partnership interests that have a K1 could have tax deductions, tax credits, or passive losses, should probably be in a cash account. If you have the ability to choose between the two, you should know the differences when you get to that point in the conversation. If you don't, all the money you need to invest is in an IRA account, then you only have one decision to make is, should I convert some of this to a Roth or should I start saving in a Roth now if you're not, right? And then just deploying the capital from an investment perspective. So that's the difference between asset allocation, which is talked about a lot. Asset location is rarely discussed.
You nailed it. We see it. I see clients use an IRA to buy a very tax efficient investment, and it's because it's their only money.
That's right.
Now, if the returns are good and they're outperforming the alternative, stock, bond, or mutual fund that they came from, it's not a bad play, but it's sad to see because they just let this entire tax depreciation play go to waste. And that goes back to, you got to be a good saver. And I think if we tend to talk about investments, and yes, everybody builds wealth through investments, but nobody builds wealth without saving somewhere or creating capital or raising capital. You got to have capital to make money. But the real wealth building platform is when you do have multiple asset or multiple account types and you start picking and choosing these investment and asset classes that fit better in different accounts. I love that you hit on that because I think that's often overlooked. It's kind of a one size fits all. This is where my money is. I'll just buy this investment. And it's got to be more thought out than that for sure.
And I'm sitting here, with my tail between my legs because, and after this, I'm going to have a conversation about that because I deploy capital from an IRA and cash. And I think I was doing the opposite of what you just said to do. And really what it comes down to is not having the knowledge about it, right? You have to know these things and the conversion opportunities. My perspective on a Roth was probably a little elementary. I thought that you can only have a Roth if you earn a certain amount of money, right?
Less than a certain amount of money because there's a cap, right?
Right. But you can make a Roth conversion regardless, correct?
Yeah.
And these are the types of things that when we sit down with our investors, we educate them on these processes. And if they don't have this knowledge or an advisor that they can rely on, a custodian that they can rely on, an investment company that they can rely on, they're going to make those mistakes. Point proven here.
Yeah. Well, look, that's the mistake that you're talking about, whether you've made it or not, who knows?
I might not have.
Right.
Let's go on record and say that, but I also may have.
But it's a super common mistake, right? And so to be fair, it's something that I would use if a client comes into me and tells me how smart and sophisticated they and their financial advisor are. I take one look at their portfolio and just where they own what they own. 9 times out of 10, I can go, if you knew what you were really doing, you wouldn't own that asset there. And then I can explain why. why. And that's just like, so.
And that's the second step. The first step is getting comfortable with something besides, the common menu of things that you can get from your financial advisor, right? When you start stepping outside the box, that's taking the first step in looking at ways to grow wealth through alternative investments. The second step, which really should be done at the same time if you're advised properly, is understanding the methodology of how to deploy that capital.
Well, if you think about it, asset location, if we were to compare this to a fast food restaurant, and I've never made this analogy before, so if it doesn't stick, maybe we got to delete it out of this thing. I don't know. But if you went into a fast food restaurant and you ordered meal number 6 and they put your Coca-Cola in the hamburger box, would that work?
Yeah, probably be an issue.
Probably be an issue, right? So, or vice versa, right? You don't want the hamburger jammed inside the 32 ounce cup that you got for the thing. So I think that's what I mean so it's really obvious and it sounds comical when you explain it that way, I think. And I've never used that before, but I think it lands. Does it make sense?
Yeah, it landed.
Okay. I thought you were going to go to the tacos again. You go into Burger King and go, I would like some tacos, please.
But that's a business model conflict, right? Yes. So when I talk about because I always say this all the time, right? I go, why doesn't Burger King sell tacos? Do the people at Burger King not know that tacos are awesome? Tacos are awesome. Everybody universally agrees tacos are awesome, right? Well, they don't, because it's not their business model, right? I bet they could make a taco. They probably even could whip up one. If you walked into a Burger King and said, hey, can somebody back there whip me up a taco, right? They could probably figure it out with the ingredients that they have back there. Somebody could figure it out in some way to make you something that was closer to a taco, but it's not their business model, right? Mm-hmm. And so understanding the business model of what people are doing, how they do business and the way they want to do business and the way you should be doing business with them is about understanding their business model. And not everybody is going to sell everything that you might be interested in. They're going to sell what they're interested in selling you. And there might be a place for that to fit in your portfolio. So.
Well, I think we're onto something with the Whopper taco. And I think if the Burger King execs are listening, they got to be looking for some solutions. I drive past 5 different Burger Kings in a month, and I've never seen a customer at any of them. So maybe this Whopper taco is the next big idea. But coming back to this knowledge base, I think the biggest challenge for investors is, where do you go get this, right? Obviously we all sound like we know what we're talking about, but we're all fortunate to work in an industry that gives us this knowledge as part of a requisite to be doing this, right? Mm-hmm. So we didn't figure this out, right? We work in an industry that teaches us this, and so we figure out how to use it. If you're a teacher, if you're driving a forklift, if you're working in tech, like, no one's tapping you on the shoulder and saying, hey, are you making good financial decisions? And so your source of education, right, is tapping your buddy on the shoulder and being like, hey, do you have an accountant? I think I make enough money to stop using TurboTax. And they're like, yeah, here's my accountant. And they're not asking, what am I trying to accomplish? They're just saying, hey, like, who's the person that can do my taxes for me? Because TurboTax doesn't really fit me anymore. And I think what we have to do is individuals and as people trying to grow our wealth, which should be everybody's goal, right? And whether the number is 200 or 200 million, that's your choice. But we all want to retire, and to retire, we need some nest egg, right? Mm-hmm. And if you think about that, how do we get that information and education? And we live in a world today, right? There's zero excuse to be ignorant.
TikTok. I thought all this information was on TikTok.
It's just your source of information.
In some form.
Is it?
Yeah.
I've never been, so I don't know the answer to that. I've just heard that. The cool kids say that.
Yeah. Well, my wife is not at all onto the finance side, right? She's artistic and we both add the value in our relationship there. And yeah, so which is great. But the other day she said, we have 2 kids, and she's like, did you know that we could pay our kids and put money into an IRA? And I'm thinking, I've worked for this company for almost 20 years. This is what I do every single day. I've known that since, a week into the job. But this was a revelation for her, and I'm not making fun of her.
No.
This is the world that we live in. And, she doesn't now. Her role in our relationship, isn't necessarily the financial part. I'm able to fill that void, but there's still this idea like that to her resonated, and she saw it in a TikTok video. And in some ways, I'm delighted by that, because I'd rather the people watching that do that than do nothing. But just think of all the education that we're missing out on, right? And so we've got to make sure that the source of our education is not just someone on the other end of a camera trying to get views.
Sure.
We're living in an information age, and just from picking up your phone, and you could use it to watch cat videos, or you can use it to get financial information. But the fact of the matter is, the amount of information at our fingertips is readily available. And I actually wish that some of the stuff we're talking about today was a part of curriculum in academia. You know, I was a general business major at the University of Central Florida, and I was required to take an elective. And in those electives, I took astronomy. Astronomy did not do anything for me. I did take a personal finance and investment class with Paul Gregg, who is still a community leader. That was the most impactful class that I took at school. But if I'm a general business major, it shouldn't have been an elective. It should have been required. And if we could teach these things that we're talking about today, think about how much better off the future generations would be.
Yeah, buying versus renting, a home, buying versus leasing a car, how insurance works that you have to buy, whether it's home, auto, life, health, disability, like all these fundamental things should be taught in school. Like, I don't know why I don't do those things. That's a whole nother conversation, I guess.
Well, I think it goes all the way back to ERISA 1974, right? So there's nothing mysterious about a self-directed IRA. It was created along with 401ks. It's a 50-something-year-old law. And I think as far as the investment market, I'm not a professional investment advisor, but it's not just the different business model. It's the distribution channels for the public markets are so massive. It's like a fire hose. And alts don't really lend themselves to that massive flow of deals. So I think just historically, it's been harder to get access to alts. People don't understand them. The first thing you have to do is realize there's nothing crazy or mysterious about any of this. Explore it sooner rather than later. Get to understand it as best you can. Get comfortable with it. And then the steps to actually get involved are really not that complicated. They're not scary. But it's, this is a 50-year-old law that I think we're using more in part. Jason, I don't know if you agree with this. Technology is so much more usable to the average investor. I feel like that really opens doors to a self-directed IRA. I don't know if you think that's true.
It does. I mean, we live in a world, and you're right. We're on the 50th anniversary of IRAs and 401ks. So in some ways, it's relatively new in the grand scheme of things, because you got to think about how generations work, right? Grandparents teach, our parents teach us, because back to your point, Carrie, there is no education for this, right? Your social circle is your financial circle, right? And so you got to look around at your friends and go, is this where I want my financial advice to come from? They're great buddies, and I'm happy to go out and watch a football game and have a drink with you, but I probably shouldn't be taking financial advice considering none of us have figured it out. So if you kind of think about that, coming back to this technology, like the accessibility is there, the access is there, and the resources are there. We're just not taking the time to go look and utilize them. Excuse me. The other issue that I see, and this is just the nature of the world we live in, is people don't like IRAs because they're not instant. I mean, think about our lives just in the last 10 years, right? I mean, we have 50 people in our office building, and I say this all the time. There's no way that the average person in this building can afford Uber Eats to show up to this office 6 or 8 times.
But it does.
But it does. And it's because they're willing to pay a 30% premium for Starbucks to have it at their door. And so the idea when you say, well, if you took that money and put it in an IRA and 40 years from now, it's like, you might as well be talking gibberish. 40 years from now, like, how does this help me today?
Such a good point.
So we've got to condition ourselves.
Now, our generation in that same office would have walked around, taken an order from everybody for Starbucks, went and picked it up, added $1 to everybody, so my coffee would have been free.
100%. No, you're absolutely right. But
that's what we would have done.
100%. And we buy convenience.
Yeah.
We buy rapid, quick, and back to your point on technology, technology's spoiling us.
It sure is.
I mean, and look at generations like, I've got 2 kids and I've got 12 and 4. My 12-year-old, from a tech standpoint, that's all he's known. My 4-year-old, because tech's advanced so much in that 8-year gap, she's as advanced in technology as he is. Mm-hmm. A commercial came on, and I promise you, she goes, "What is that?" She doesn't even know what a commercial is, because everything in her life has been on demand. So it's really hard, because money just naturally falls into that same trap. And so we don't think that we're overpaying for food. We think we're buying convenience, right? And so we can move into this world where I'm buying. And guess what? That comes at the expense of saving. And I'm scared to death about the younger generations, not because I think they're bad. Every generation is different. And I love different. And there's a lot of different ideas that are better, right? But when it comes to money, man, I mean, people that were raised in the Depression era, people that were raised as baby boomers, like, it's a dying breed. Mm-hmm. And the idea of saving and saving till it hurts and figuring out how to try to put money to work, I think the few that are doing it really well, but there's unfortunately a lot of people that aren't doing it as well today.
And I think you bring up a great point. He keeps saying saving, and I know this was kind of supposed to be an investing conversation a little bit, but you can't out-invest a bad saving problem. So you have to learn to become a saver. I have people all the time, what should I invest in? What should I invest in? Well, how much do you have saved? Well, no, but what do I invest in? I'm like, it doesn't even matter what you can invest in if you don't have enough dry powder to ultimately be able to invest. So you have to learn to become a saver first, which is self-discipline, to later become an investor. And that's a fundamental thing. That's like, you can't learn to run the West Coast offense until you know how to block and tackle.
Most people have limited financial resources, right? A few of them have no limits. So if you have limited resources, you just have to make the decision to learn some new things and carve off a little, and it starts somewhere.
And that there's not a sense of immediacy that's going to help. That, what do they say? Investing is like watching paint dry or grass grow. You know, if you want that quick fix, the GameStop, the Dogecoin, it's happened and people do that, but that is an anomaly. The typical way to grow wealth is slow and steady. And we tell all of our investors and the people that are investing with Coastal, the stuff we're doing is not sexy, but your bank account will be sexy if you trust in it, right? And you just have some patience and get the proper knowledge and advice and access. Speaking of access, one of the things I wanted to talk about in conjunction with NuView is, what does it take to set up a self-directed IRA? Is this a difficult process? Who can do it? For people that are learning today about what an IRA is or what a self-directed IRA or a private custodian, what's the process of setting one up?
Super simple. You know, it's no different than setting up an IRA at Schwab or Fidelity or Merrill. You can start your IRA with us. We have clients that open their account and make their first contribution. But because all these accounts are self-directed, typically most of our clients are coming to us with money already saved. They're coming to us with a former 401k plan. They've got, previous employers, and those 401k plans are just sitting there.
Because when you leave an old employer and you're no longer there, if you had a 401k plan, you could roll it over and take it anywhere you want to go at that point.
That's right.
Okay. Good point.
But you likely need somebody, or should have somebody, to manage that, right? You can't just take your 401k, roll it over, and just have this previous qualified plan. What are you going to do with it? Who's managing it? Somebody's managed it for you for years. And that's where somebody like a private custodian or NuView comes into play.
Yeah, and you'd be amazed. There are entire businesses on missing participant, lost participant plans. And when I say, I'm talking in the millions and hundreds of millions. So what that means is people join a company, they save in their 401k, they leave the employer, and they have no idea what they even have or where it is. They can't find the person. And to me, that one's crazy. The other thing that's crazy to me is, and I ask this question all the time when I'm in front of audiences, and it's one of my first questions is, how many people in here could name 80% of the assets in their retirement account today? And everyone's kind of like, it's like 50. How many people in here can tell me one asset that they hold? And what that tells me, and it's scary, is that people just don't even know. So to your point about you got to be a good saver, like, you check the savings box and then you ignored the investment box. And then you have the other side of that coin, which is the people that ignore the savings box and they jump into the investing box. These are the people that were buying the meme stocks and the GameStops and these meme stocks and the Dogecoins. And, you're literally gambling with wealth, right? Take money and go to the blackjack table if you want to gamble. There's nothing wrong with that, right? Don't make it your life savings, make it a few bucks, life goes on. But building wealth is not a game. Right? It's not something that's going to happen overnight. It is going to take time. And guess what? Sometimes you do get lucky, right? Sometimes a deal went from a base hit and became a grand slam. Celebrate those. But don't think that everything now has to become a grand slam. And the worst thing that happened to the market is that it went up like a rocket ship, because now everyone's expectation is that it will stay a rocket ship. And fundamentally, everyone knows that's not physically possible.
No, everyone doesn't know that that's not physically possible. So it's called a parabolic curve. That's what it's actually called. You can Google that if you want. And so when you see a parabolic move up, it never continues to do that, even though your emotions and your behavior, people start getting FOMO in a parabolic move and going, oh my God, I'm missing out. I have to get in. And when you start feeling that way, that's probably about when the musical chair stops, right about that point. So, as a matter of fact, I think, and this may not age well from a time perspective, NVIDIA had exploded recently and like all-time highs, biggest capitalization, all the other stuff. And then now I think it's had the largest pullback in the past 6 weeks of anything in the marketplace, right?
It's elastic.
That's right. Absolutely. And people think that, things do not go up forever. Nothing goes up in perpetuity.
I think that's where your team of advisors really comes in and toes the line for you. You need people around you that are market aware or tax aware. And, you put your team together and you rely on them, and you hopefully don't make emotional decisions and think long-term. And like I said, I think limited resources is such a big piece of this. How are you going to chop your pot up? You got to take care of your family. You got to pay your car payment, your mortgage payment, but you save a little, put it aside, and save and explore some new options.
Look, there's a whole bunch of financial research out there that's interesting. I read, like people kind of at the bottom of the socioeconomic spectrum, like they don't save, right, today. And they kind of call them like a scratch-off mentality, right? They would rather take their paycheck on a Friday afternoon, pick up a 6-pack of beer, buy $20 worth of scratch-off tickets. They know saving $20 a week, in their opinion, is never going to get them anywhere. But if they hit a scratch-off ticket for $50K or $100K, boom, life-changing moment. And there's a lot of people in the world that have that mentality. And I think it also skews the younger you get today, like also kind of have that mentality, because meme stocks and Bitcoin have felt like that to a lot of people, like a scratch off mentality. I put a little bit of money in something and I get this astronomical upside to it. And that's not investing at all. That's speculating. And there's a huge difference between speculating and investing. Investing is slow and steady. We will get there over time if we rinse and repeat over a long period of time. Speculating is, I'm going to put everything I've got on this one idea, and if it pops, great, and if not, well, I'll wait till the next idea, and hopefully I've scratched a few coins together that I can lean into.
I love that analogy. My family owned a convenience store my whole life, and I grew up, very blue collar, running a convenience store. And I can't tell you how many times Friday at 4:00 there was a line at the lotto counter, and they would take them outside. We had 2 trash cans. They would scratch them, and they would come in and they would buy 100. They'd come in with 60. They'd buy 60. They'd come back with 40, and they would win 50. And they're like, yes, and you're like, you just lost $50.
You lost $50.
But that mentality, and I think you nailed it. It's just that instant gratification. We want, and there's nothing wrong with throwing a little sidecar bet on something. There's nothing wrong with saying, hey, I don't know enough about crypto, right? And I'm not putting my life savings in it, but you know what? I'll take a few bucks and see. Building wealth doesn't mean you can't go out and take some gambles.
Sure.
It just means that you recognize they're gambles. It's not important money to you. And it's a small enough percentage where if it goes up, you feel something and feel great. If it goes down, that's okay too. Life goes on and you still have your core investments.
But if anybody would have showed that person that lost $50 in that transaction, what 50 or the 100 that they started with a week over a 10-year or 20-year period would look like if they put it away, no one's ever showed them that. No one's ever taught them that. Yep. I'm the first person in my family ever to go to college. We never had a conversation about money. Well, we never had any money, so there was no conversation to be had, right? But like that was something I never knew growing up. I didn't know how to open a checking account until I got to college, right? One of my roommates go, why do you keep a bunch of cash in the drawer over there? I go, where do you keep your cash?
And we're going to deploy that money tax efficiently. Don't forget, because we don't want the 60 grand. We want the million.
True. If we could put it in an IRA or self-directed IRA or tax-deductible self-directed IRA
We have about 8,000 clients over at Moss, and we have a handful of lotto winners. And even the winners, it's a tough story a lot of times.
Yeah.
So
there's entire shows dedicated to people that lost all their money through some sort of lump sum payout. And it's sad and it's unfortunate and it's the reality. It's no different than, there's a show Broke that ESPN did on athletes. And, money is work. It's not easy. And you have to be a good shepherd and steward of it. And if you go out and build up all these expenses and you don't think about how these bills are going to get replaced, if you don't have a source of income. And I think, if I go back, I don't know if you guys are, I'm not honestly not much of a Kiyosaki fan these days, but I still think Rich Dad, Poor Dad should be read by every high school student. And it's not perfect, but it just tells a story of managing money in a real world scenario that if just people got that little bit of info, I think you'd see a 20 or 30% bump in socioeconomics around the way that people treated money.
Jason, I completely agree, particularly speaking about that book. It was one of the first, do we call that a self-help book?
Yeah, I think so.
It was the first one that I read out of school that impacted my life. After I read it, I went and got my real estate license only because I didn't want to pay a commission to a realtor. I wanted the commission myself. Then I practiced real estate for a couple of years, but just learning assets, liabilities, can't say I was paying attention too much in college when they taught the basics, but that book I dove into and it really did open up my eyes. I do think it should be a part of curriculum. What do they have now? What are some of the books that, students are supposed to read in English Comp 1 and whatnot?
Yeah, I think we could replace To Kill a Mockingbird. I think
that's where I'm going.
Catcher in the Rye. It's a good one, but I think if I look back, I haven't really used any of those things in my life today. So not knocking the entire educational system. I can only imagine how hard it is, but it just baffles me. I think we've discussed it already. Like, how do you not give people education? And if you expect them to get it at home, then you're just going to continue the socioeconomic cycles that we're in, right? And so I was fortunate enough to be in Guatemala years ago distributing some wheelchairs for one of our nonprofits, and the former First Lady of Guatemala was there, and she said, there are two things that you have to remember in your life. Never forget this. She said, you cannot control what country you're born in, and you cannot control who your parents are. And she said, those are two lotteries that you hit. If you're born in Guatemala, the likelihood of you being poor is significantly higher than if you're born in the United States. And she said, if you're born to good parents, you're likely to be raised good. If you're born to bad parents, you're likely to be raised bad. And I've carried that with me. And I think it's so true. And if we want to break these economic kind of constraints that are plaguing the world, right? We've got to start getting down at the early level, because by the time people are 18 and 19 and 20, their money habits are already developed. Now, I'm not saying people can't change, but it just gets harder. But if we can start teaching those habits in school and helping people see that, hey, saving that $5 every single week versus buying something silly, will over time materialize and matter and have impact. But we're not doing that. And I think it's up to us. And this is maybe a challenge to all of us as individuals. Like, how do we do it? Right? We can't sit and look at the government and say, they got to figure this out. Right?
That's not going to happen.
How do we do it? Shows like this, et cetera.
So I can tell you one of the most transformational times of my whole life. I did not come from an educated family. I did not come from a wealthy family. I was born in the right country, and some of those things played out for me in the genetic lottery. However, that plays out a little bit. I still got good hair. I'll take that. But so 20 years ago, I was in a conference room in Dallas, Texas, and there was probably 5,000 people in this conference room. And there was a guy by the name of, I believe his name was Brian Dodge. And I don't even know if this guy's still doing what he does, but he gave these big corporate presentations to people at the time. And I do not remember the 150 slides that Brian had that day. I cannot tell you that. And I cannot tell you the core message of what he was trying to tell. But I remember 4 slides very specifically from that presentation, and I have never forgotten them. So he asked the room, or he asked the question, he says, hey, how many books do you think an average American reads in a year? And he just asks around the room and hands go up. And at the time, given this is 20 years ago, when they're done, he has a slide that says average American reads less than 1 book. Okay. So the next slide says, how many books does the average CEO read in a year? And everybody answers the question, goes around. And at the particular time, he says 52 books. And it was more specific than that. He said 3 books a month on their industry and things that are related to it, and 1 outside the industry to try to get new ideas and concepts, right, from another place. So third slide goes and says, what do you think is the income of an average American? And everybody guesses. And at the end of it, he puts it up there, and it was like $33,000 is the average income of an American. And the 4th slide, as you can guess at this point, is what's the average income of a CEO, right? And at the time, I believe it was like $6 million or something. My point not is the amount of money, it's that more books, more education creates more value over time, right? And that's not something that instantly happens for you, but that's something that compounds over time. Needless to say, like, I read and educate myself 95% of the time. The other times, I sit here and I tell other people about the things I know. So like, but had I not have experienced that, my parents never told me to read. Nobody had ever said, you should pick up books. It's a good idea, you know, and they're free. You can gain access to a lot of information. And this is before the internet was really a thing where you could get real education on the internet. Today you can. White papers, podcasts, YouTube videos are all great places and good resources that are way more entertaining than the stodgy stuff I had to try to consume to learn a lot of the stuff that I learned.
And education's critical, but the fact of the matter is some people are not going to take the steps to educate themselves. But Jason, you said being a good steward of your money and your decisions. Yep. And then you referenced broke from athletes. You don't necessarily have to be the person that does the thing, but you have to rely on an expert that does do the thing, right? So if you are not going to take the time to understand everything, you can very easily make a decision to speak to a qualified professional that can give you the information that you need. And we're talking about a higher echelon of that here, of investors, right? We can go down to just somebody managing your money properly. A doctor is going to do doctor things. A surgeon is going to do surgery. They probably don't have a lot of financial knowledge, but they should have a trusted financial advisor or a partner or an investment company like Coastal or a custodian like NuView to rely on to be at least a steward of the right decision to manage their money.
Sure. 100%. You got to have a team. Yeah. I mean, think about anything that has ever been successful in life usually involves some form of a team. Right? Not to say there's not individualism that can lead to success, but it is a team and it's checks and balances. And I mean, just in my own household, you know, I need a reminder and I consider myself very good with money and I can easily fall in the same traps, right? I can easily say, you know what? I don't want to go grab, let's just Uber Eats, right? And, you know, my wife can say, we have stuff to eat. Like, let's not pay the premium to get it. Those are the types of checks and balances that we need. And whether that's our social circle, whether that's in our personal lives. But then beyond that, there's so many professionals that will help you do all of this. Yeah. And guess what? Some of these professionals get paid and that's okay. Right? Like I love when people ask, you know, about a CPA and this you probably hear all the time. It's like, what does your CPA charge you to file your taxes? I said, I don't pay my CPA to file my taxes. I pay my CPA for advice. That's what I pay them for. They file my taxes and I'm appreciative of that. So I don't want to do it, but I pay them for advice. Right. Right. And so what I have to value is how much is that advice worth to me? And that's what you have to kind of look at. And I think we go back to what's it cost? What's it cost? And it's amazing because the same people that ask what it costs are the same people that order Uber Eats. Because if you genuinely wanted to know what it costs, just look at the total on Uber Eats and you would never order it again, right? Not picking on Uber Eats, but definitely picking on it. Yet we look at professionals and we go, well, there's fees to do that. Well, of course there's fees. People have to get paid for their services. And I think the most common misnomer and you know, as all custodian, we charge fees. We have to charge fees because I make no money on your investments. You go invest with Coastal, you're going to pay me fees. You go invest with any other deal or any other opportunity, you pay me the same fees, right? There's no difference. We are non-biased. We are non-discretionary. We have no financial interest. And I always get people say, well, Schwab doesn't charge me. And I think to myself, so you think that Schwab is there in all these commercials, has big buildings in every major city, and they're a nonprofit? You know, it's like charging you for your water and giving you the steak for free, but charging you $80 for your water and you think you got this great deal. You're paying.
You answer that in a much nicer way than me because I would say, so either, let's play this out for a second. So either Schwab doesn't charge you or you're not smart enough to know how Schwab charges you.
I didn't want to say that, but I don't disagree with that comment.
You mentioned a team. I want to touch on a minute about the team that we have sitting here, obviously Coastal and NuView. We've been working together for a few years. Talk a little bit about the dynamic between Coastal and NuView and how we interact, how we engage. Are people talking to you first and then coming to us? I know the answer to the question, but talk a little bit about how the relationship works, if you don't mind.
Yeah, and just for full disclosure, I always want to make sure that everyone understands our role. We are a passive self-directed custodian. And so while we're sitting here with groups that we have very long-standing relationships with and have a lot of mutual clients, ultimately any investment decision made by any one of our clients is our clients alone. Right. So we don't steer our clients in any way. So any relationships that we have built over time are exactly that. They're not endorsements or suggestions that you don't have to go and do your own due diligence. That's the self-direction. So please don't rely on us for any of that. But going back to the question, the way we work with groups like Coastal is we're a resource, and we're both an educational resource. So, as you're engaging with clients or clients are engaging with you, there's a lot of questions that come up. And so certainly there should be lots of questions on the investment side. And you should never apologize for asking someone that you're going to invest with questions, right? In fact, if they can't answer your questions, that's a sign to run, right? They should be, and even if they're sweating a little bit, they should be tough questions. It's your money, right? Whether it's $1 or $1 million, it matters the same to you. So as you're interfacing with groups like Coastal, we're here to be that resource on a few fronts. A lot of times there's some tax decisions. They have qualified money. Should I convert to the Roth account? Those types of things. And so while we can't tell you what you should do because there's way too many personal things inside of that, we can give you what are the rules? What are the conditions? What do you have to think about? What is maybe some of the things you should go talk with your financial advisor or your tax professional about? The second thing that we do is we provide the custody and administration should someone want to invest with a group like Coastal, right? So we're here to service the IRA. And the reason that you can't hold, or I shouldn't say can't, but generally don't hold alternatives at Schwab is they likely won't do it unless you've got a lot of zeros, right, behind your retirement account balance. And then secondarily, they really don't like to hold private investments. Not because they're bad, it's because they're manual. There's manual valuations. They don't just plug it into a system and the ticker symbol populates every day. And so it's a little different. We built our business around that. That is our business. So when someone says it's private, it's difficult, we say, well, it's difficult maybe if you're not set up for it, but for us, it's easy. So yeah, we're here to be that kind of neutral third party. We're here to be a custodian. We're here to give you education and information as it relates to things to consider, et cetera. And through that partnership and through that relationship with groups like Coastal, it gives you the ability to feel comfortable once you've done your due diligence that you not only have access to institutional grade assets, but you feel comfortable with where they're sitting, how they're custodied, how they're reported, that sort of thing.
Perfect. I have a question. I generally don't know the answer to this question. Current Coastal clients, people that are currently investing with us that are making contributions personally out of their cash, should they consider opening a self-directed IRA and making investments through that?
So, there's a lot of ways to answer that question. The short answer is, of course. And the reason I say of course is you should have as many buckets of money as you can get. And I think Matt highlighted this with the location aspect, right? If you only have one, even if you've got 10 million bucks and it's all sitting in one account, that's probably not good, right? You need money diversification and you need investment diversification. Those two things are mutually exclusive. Decision A is where do I park my money, right? Traditional Roth, Simple SEP, ESA, HSA. Those are just retirement accounts, qualified plans. Then you've got personal buckets, right? You can put it into trust and all these different things. And so you've got this myriad of places to park money. And then step two is what's the best investment opportunity inside each bucket? And I love the way that Matt framed this asset allocation is you should be looking and saying, hey, if Coastal is delivering the returns that I'm expecting, right, with the comfort that I'm expecting, should I do more of that? And then the question is, if the answer to that question is yes, I should do more, then should I do it from the same bucket? Or is there some benefits now, right, to put it into different buckets? And those are all part of this decision-making process.
And I think a follow-up to the conversation today may be talking about the different buckets and educating, of course, our current investors that are working with us and people that are considering investing with us about all those different buckets, really diving into it, lifting up the hood, understanding the mechanics of each of the different plans. That would be a great follow-up.
Mm-hmm. So one of the reasons that is hugely overlooked about one of the benefits of investing. If you take the investment conversation out of it and you take the tax conversation out of it, a qualified retirement, an ERISA-based plan, or something that becomes an IRA, there are creditor protection attributes to the money that's there. So if you own money in a cash account, commonly called a brokerage account or something like that, much more easily attachable by creditors. If you own something in an IRA or a 401k account, much harder to get after because it's under the Employee Retirement Act, ERISA. So if creditor protection is of concern to you, and some people's jobs or life is a lot more litigious than others. Maybe if you're an attorney or a doctor, physicians carry about creditor protection, right? Mm-hmm. So that could be a good for them. I was having a conversation with a client just the other day. Her dad ran a stop sign and hurt somebody, and a personal injury lawyer got involved, and he owned 3 duplexes and lost them all in the accident when he blew through the stoplight and hit somebody. So I'm not suggesting that he had the ability back in the day to buy those assets inside of an IRA account with a self-directed custodian. But if he would have had the choice and didn't make it, certainly years later, it negatively impacted his financial situation by not doing so.
Asset protection is critical. And even if he didn't have them in an IRA, he could have bought them through, maybe a land trust or other means. And so, you nailed it. And I guess, I don't know when this will actually air, but, O.J. Simpson comes to mind. We've referred to this as the O.J. Simpson rule, which is, O.J. Simpson was sued by the Goldmans, right? $30-something million, I think at the time. He filed bankruptcy, yet he still had his home in Palm Beach because it was Florida based and it could not be attached to the suit. And he had his NFL pension plan. And it was rumored he was getting like a couple $100,000 a month from his NFL pension plan, and it could not be touched. So if you think about the value of that, had he taken a lump sum out of that and just put it into his bank account, it would be gone. Right now, obviously, it's a heinous crime, and that's a whole separate example, but it draws the parallel to anything can happen. And we're all human beings. Heck, we're all guilty of picking up our cell phone while we're driving. And all it takes is look down for a second, run a stop sign, hit someone, and some overly aggressive attorney could come in and say, hey, we're going to attach everything that you have personally. So, that's like the third leg of the stool, which is in saving, investing, tax deferral, and then creditor protection.
Protect it. If you got it, protect it. Right?
Absolutely.
Knowing how to do it. So,
does anybody have anything else that we want to touch on today regarding our conversation on self-directed IRAs, custodians? I think we covered quite a bit.
We hit fast food. We managed to hit O.J. Simpson.
I want to go back to the fast food for a second. I am a huge Whopper guy. I'm not a big Burger King guy, but my guilty pleasure is a Whopper.
I like the taste of a flame grilled burger.
That's what I'm saying.
Yeah. Am I the outlier here? Wait a minute.
I'm not saying I'm not buying enough to keep them in business by any stretch of the imagination.
I bring this up all the time.
BK down, but I haven't been there in I don't know how many years. Yeah.
It's been a long time. Yeah. It's been a long time.
My guilty pleasure.
I do prefer the sandwich as a breakfast sandwich over the McMuffin or whatever the other one from the other guy place, whatever. So I don't know. The only other thing that we talked about at all, and this may or may not fit, that I found interesting was when I was in grad school, we took a class on the impact of sudden wealth. And the impact of sudden wealth is winning the lottery, like becoming a professional athlete, getting a big inheritance or something, maybe winning a lawsuit. A whole bunch of money just automatically shows up. So one of the behavioral issues with something like that is somebody that becomes wealthy over time becomes wealthy slowly. You get a chance to build new skill sets as you build new wealth. So as you're going to make mistakes all along the way and learn new things, right? Oh, how do I be tax smart? How do I diversify? How do I protect some of this stuff? You get to learn these things over time. But when all this money is dumped on somebody like instantaneously overnight, they don't get to learn those things in steps. It's just you go from 0 to 100 overnight. And so, the statistics are more than 80% of people that get the impact of sudden wealth lose all of their money and have a worse life before, because not having is one thing. Having and then not having is way worse, because now you know what it was like to have. And I can't tell you how many people I know that at one point were wealthy and are no longer wealthy. And since the day they've lost the money, they're bitter. They have anxiety. Like, what could have been? I could have done things different. And they always feel like it's going to go back and revert. But when you hear their stories, you're like, oh, the thing that made you wealthy was kind of an outlier, one-time lucky event. You didn't build it consistently over time. So it doesn't surprise me that you grand opening, grand closing. So,
That's good stuff.
yeah, just learn. And if you can't learn fast enough, learn how to hire people that have learned, right? And find people that not only you trust, but that you like. Because trusting people doesn't mean you can do business with them all day, every day. Because there's people I trust that they call me and I send them straight to voicemail because I don't want to talk to them because I just don't enjoy the conversation and the interaction. So people that you can trust, but people that you also enjoy their company and their teaching style and the way they do business. There's plenty of people out there that you can trust to help you do a thing. Find the people that are goal aligned with what you're trying to accomplish and deliver that information in a different style. Because I would say that Coastal, by and large, is a non-traditional business model, and it's not for everybody.
Speaking of enjoying company, I enjoyed your guys' company today. Thank you for joining us. Jason, thank you so much for joining us from NuView.
Thanks for having me.
And anybody who's interested in a private custodian or a alternative investment custodian, NuView is here in Florida, particularly in Orlando, Florida.
Yeah, we've got a processing office here. We've got a trust and compliance office in South Dakota, but we cover all 50 states. We've got clients internationally. So yeah, we do a little bit of everything.
Awesome. We'll have everybody's contact information after this. We appreciate you joining us on this episode of the Coastal Conversation. Have a great day.